So by now you probably know what it is I do. I teach people like you how to take back control of your money by teaching you how to become the bank. Now, how do you become the bank? Well, it's quite simple. You do what the book, Becoming Your Own Banker, tells you to do. You become your own banker. And you do that by changing one thing, and that is where your savings goes first, and then add one step. So change one thing, add one step, and that one step is add a process to what you do, called the infinite banking concepts. It is literally just a process that teaches you how to take back the banking functions in your life. So if that's what I do, and I do this for thousands and thousands of people, I teach this to hundreds of thousands of people, why is it that more people aren't doing what I'm doing? It is lucrative, but it requires me to solve a lot of people's problems. So when I say it's lucrative, that's something that we're going to talk about today. We're going to talk about the machine that we use to create your private banking system. The machine we use to run our money through to then do the infinite banking concept. So what is that machine? That's always what people want to talk about. The machine. What is this magic machine that pays guaranteed interest and dividends, and it does it in a tax-free environment and protects me from judgments and liens and provides a legacy for my family, and on and on and on. Well, here it is. It is nothing more than a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. There, I laid it out. And I want to also preface, Will Rogers, my buddy who made this statement, he said the biggest problem in America is not what you don't know. The biggest problem is what you think you know that just ain't so, which is perfect for today's episode because you probably think you know what just ain't so about whole life insurance. And we're going to dive deep into why most advisors and insurance agents do not know what it is we do, and they do not know how to build a specially designed and engineered whole life. Let's dive in. So today I put my reading glasses on because I wanted to look smarter. That's all. I mean, what do you think? Smart Chris? Dumb Chris. Smart Chris? All right, you get the point. I'm really not all that smart, but what I am good at, I'm good at creating, and I'm good at learning something and going deep into it. So what I thought I would do is kind of talk a little bit about the specially designed and engineered whole life insurance policies and why it is that more than likely your financial advisor and your insurance agent don't have a freaking clue how to build one of these policies. Even though they're licensed to sell the life insurance, they absolutely know what whole life is. They know what whole life is, just like Dave Ramsey thinks he knows what he doesn't know about whole life. Because Dave Ramsey would say to you that whole life insurance is one of the worst places you can put your money. You should just do what Dave says. What the 95% conform to Dave's ideas that buy term and invest the difference, which absolutely factually is a failed model because it has been proven time and time again. Not that the term insurance isn't cheap and actually a pretty good life insurance if you're protecting something for a term of time, but more specifically, the save the difference, the invest the difference. Because most buy term invest the difference plans fail not because the term insurance doesn't provide cheap protection for one's life during a term of time, but more so because people fail to actually save. They fail to invest the difference, or they start it and then they take it out and it just falls apart. They don't do it. That's all there is to it. So back to the specially designed whole life. In order to design whole life policies the way that we do to benefit you and allow you to use your policy's cash value early on, actually allow you to use your cash value immediately in the first 30 days, it requires the agent, the advisor, me and my team, to take a reduction in commissions because of the way we design it. Why would that be? Like,
you can't say to your financial advisor, hey, this guy Chris said that you could reduce your commission and give me 60 to 90% more cash value right away.
Your advisor's going to say, I can't give you my commission, and he's right. But what your advisor or agent could do is build the policy contract so that it's built in a way that reduces the whole life's base death benefit Then, if needed, and I'll give you a couple examples, increases the death benefit to meet the IRS Max 7 pay rule, but increase the death benefit by adding, Dave Ramsey should really thank us, a term rider. And usually the term rider is on the policy for 7, usually no more than 10 years. Why? Because we don't want the added cost. And what does Dave Ramsey say about the cost of insurance in a whole life? It's overpriced and pays way too much in commissions to those agents. So if I tell you that we reduce our commission 60 to 90% by reducing the death benefit, where all the cost is in the whole life, we add one of those term riders that Dave Ramsey always tells you to do inside the whole life policy, and we do that to meet the IRS guidelines, and now you've got yourself a specially designed and engineered whole life. And guess what? I gave so that you can get. I gave up commission by building it this way so that you can have more cash value early on. So why is it that your advisor or agent probably doesn't know about this? Even if they do, they don't want to talk to you about this? Well, let me ask you this. Let's just pretend that you're a financial advisor. You're an insurance agent. Pick one or the other, okay? And you've got a client, and you know that you can build a policy for that client because that client has a need for the death benefit. That client wants liquidity in their money. They want a tax-free environment. They love the guaranteed idea of having guarantees on their money. So they tell you all this stuff. So the product fits the bill, fits the needs and goals of the client. And that advisor knows, or doesn't, that they can design this whole life policy in a way that fills that client's needs and goals. Basically solves that client's problems. In order to do that, that agent or advisor will reduce the amount they make in commissions on that policy up to 90%. Well, how many of you think your financial advisor would just be so excited about taking a 60 to 90% cut in their pay just so you can have 60 to 90% more money? How many of you? Come on. In the comments right now, tell me, how many of you think your advisor would be excited about that proposition? Well, I got another thing that you guys all should be really excited about, and that is this. Hit that subscribe button because I'm putting videos out all the time talking about the truth, the real stuff. And not only that, to be notified every time I put a new video up, click that little bell, smash that bell so that every time I put new content out, you will be, you all right? Cash, shh. Man. When I hit it, it went flying and it nailed Lazy Cash, our kitty cat in the head, but no kitties were harmed in the making of this episode, I am happy to say. But please, the cat took one for the team. Click the little bell for crying out loud. Well, let's dive in. Let's talk a little bit about these specially designed and engineered whole lives. And I've got two of the different companies here in front of me. And I want to really drive home this commission thing because it's a big thing that Susie Orman and Dave Ramsey always say, oh, those commissions, they're so high in those whole life policies. So let's just prove it, right? Let me just tell you why you probably aren't hearing about this, why your advisors and agents aren't telling you about this, and why they probably never will in the future because they don't want to take a reduction in their pay. So here's two different companies that we deal with and two different policy designs. Now, I did different dollar amounts, but I want to just talk a little bit about this one, okay? Because this one's pretty freaking cool. Now, this would be for a client that wants really high early cash value. Maybe they want to put the money in and immediately take the money out and use it for a real estate deal, a private lending deal, or just invest the money in something else. So this one shows a client that has $100,000 just sitting somewhere else, and they decide to change one thing, and that's where that $100,000 goes. And they say, hey, I want to put this $100,000 into one of those whole life policies, but I only want to put it in one time. And then each year, the client wants to continue to save money to the tune of $10,000 a year. So let's get the numbers right. Client's got 100 grand sitting in a bank account or somewhere else, wants to change where that goes because the whole life pays a better return in a tax-free environment. So they put the 100 grand in, we call that a dump in. Money comes from the left pocket and goes into the right pocket. That's it. Okay, we take $100,000 out of our left pocket and we put it in our right pocket. That's all that happened, okay? One time. And then each year we're going to save $10,000. You can do it monthly, quarterly, semi-annually, or annually. So that's the details here. So what does that result in for this particular client? Well, with this company, which I'm not going to give you the company name, hit me up in the comments and I'll tell you which company this is. But this company would basically have available at the end of the first year after the dividends paid. So there's two ways you make money in a whole life. a guaranteed interest rate, okay, that is paid and compounds daily. Okay, so every day, we always say every day you have more cash value than you did the day before, because the interest is calculated on a daily basis. But dividends, okay, which are not guaranteed, but they have paid dividends. This company, I'm gonna get this wrong, but they paid consecutive dividends every single year for 140 plus years, because I can't remember exactly how many years they've been around, 146 maybe, never missed one. But dividends are not guaranteed. So at the end of the year, if you put 110 in the policy, you got 103,661. Okay? What does that work out to be? Well, it's better than 90%. So you have over 90% of your money available to be used. But what was the trade-off? Well, let's just do the math. Now, let's just say this was a regular whole life policy, or God forbid, it was one of those IUL policies. The $100,000 that went in, you could put that into a regular whole life as a dump in, you could put that into an IUL, and typically it's counted as what they call a paid up additions dump in. Okay, and the compensation on that, the commission on that dump in is severely reduced. It's about 2%. It varies company by company, but about 2% with this company. So if you put 100 grand in, the commission on that 100 grand is about $2,000, okay? 2%. So that's the 2%. So 2 grand comes away from the 110. That's the commission. Now, how much is the rest of the commission? Okay, because that's not the only commission. Remember, we're putting $10,000. Now, this is where the game changes, because it wouldn't have mattered with that $100,000, whether it's a regular whole life or a specially designed, but the next part would. If your agent or advisor decided to build you a whole life, dump 100 grand in, you know, they made 2 grand right there, okay? But now they take the 10 grand and they just put it into a regular whole life. How much would they make? Well, let me just tell you, the minimum they would make, if they were like brand new, low in the game, and had no real production credits or anything else, would be about $5,500. How did I figure that out? It's simple. It's 55% of the $10,000 premium that you're going to put in every single year, which would result by most companies at a minimum of about $5,500 in commission. So $5,500 plus the 2 grand, how much is that? $7,500. That's a regular whole life. How many of you think that's a really good day in the office? You sit down with your agent puts together a regular whole life, or an IUL would actually be even higher commissions, but let's just keep it level. And they make $7,500. You feeling good? You probably aren't, right? Because that's a lot of commission. And you know what that would result in? How much cash value would you get out of that $10,000 deposit you put in a regular whole life? 0. Why? Because most of it was paid out in commissions, silly. So what do? Well, when we design a policy like this, we design it and we strip out most of the death benefits. Same 10 grand in premium deposits goes in, but only $3,500 goes to the base. The rest of it goes to the paid up additions, which we all know now, 2% commission on the paid up additions. So $3,500 is what we're compensated on at 55%. So I did the numbers, okay? This commission on this policy would be $1,098. I ran the math on it, okay? About $1,098 on this one is what you'd make. And I even figured out the PUAs into that. So your commission would work out to be just a smidgen total commission, around $3,098 compared to $7,500. Do you see the difference? Do the math. So let's just do it for you, okay? So if we just were to take the $7,500 for the regular minus the $3,098 on this one, that's $4,402 different. Divided into 10 grand, that's a 44% reduction. That's a big reduction, but that's because I rolled in the PUA. If I get the PUA's 2% out for that 100 grand, it's probably about an 80% reduction in commissions. Because remember, largely that $2,000 in commission was the same, whether it's a regular whole life or this one. Now, some of you are like, get to the point. Great, the point is this. This policy, the specially designed and engineered one, where the agent and advisor had to give up commissions, where we design the policy so that you have access. That 10 grand you put in the second year, how much do you think you have to use of that 10 grand? Because I told you it was 0 in a regular whole life, right? How much do you think you got in this one? Well, $10,691. How do you like those apples? Yeah, that's called compounding interest, baby, but it's also compounding interest where there's not as much in fees coming out. The cost of insurance is reduced significantly. The term insurance is very inexpensive in this plan, but how much death benefit do you have? Well, in this policy, with the term, $1.9 million, and this is a 34-year-old standard non-tobacco person, doing this policy. That's right, $1.9 million in death benefit should you die, but that death benefit is drastically reduced. In the 9th year, your death benefit goes from $2,077,000 down to $578,994. Why? We dropped the term. I know, Dave, that term was really cheap, and it served us well, Dave. It served us well during that period called the MEC 7 pay, the 7 years. But after the 7th year, we don't need it, because we're building a policy for maximum efficiency. And what does maximum efficiency look like in the 9th year? Well, in the 9th year, you can no longer put $10,000 in premium deposits in. You can only do $8,902. So if you put $8,902 in the 8th year, how much money do you think you have to use that year of the $8,900? Well, I think you're going to be quite surprised, but you have $16,666. How do you like that? Specially designed and engineered for you to solve your problems, to give you more cash value, to pay us less so that you have more. That's what we do. But that's also what they don't want to do. Are you picking up what I'm putting down here? I'm not trying to make this all about the numbers, and it doesn't even matter what this shows. I just wanted to give you a reference point. I wanted to give you factual dollars right off of the illustration so you knew how this worked. So at the end of the day, I think I gave you a little bit of information that allows you to really make a more educated decision, to also understand why most advisors are not talking to you about this. They're trying to sell you what? An IUL, an index universal life. They're trying to sell you that or a regular whole life so that they can maximize their compensation. Because if you made $7,500 on that regular whole life versus a smidgen over $3,000 in the ones that we design, or that design I showed you, if you did an IUL, do you realize the commission would be way more? It'd be like $10,000. So why are IULs the #1 product talked about by financial advisors? Is it because it's really the best product for you? Or is it because it's the best product for their pocket? Is it because they get paid the most? Is it because it shifts the risk from the insurance company and puts more of it on you? I really urge you to start thinking about why it is you're being told the things you are. Why is it that so many people, Dave Ramsey included, and all those Primerica know-it-alls, all of them telling you buy term, invest the difference? Who benefits from term insurance? Well, when there's less than a 2% chance actuarial that you're going to pass away within that term, who wins? The insurance company. Why? Because they're paying out on less than 2% of all term policies written. So that makes the term policy a pretty freaking profitable product for insurance companies. If you were an insurance company and you were sitting at the top of the company, what product would you want all of your agents and all of your advisors to sell? Well, the most profitable ones, of course, which just so happen to be term insurance and probably IULs. Both products shift the risk from the insurance company and puts it on you, actuarial and factually. These stupid whole life policies that we do, and only, that's all we do, they are guaranteed to pay out. So are they the most profitable for the insurance companies? No. But they are profitable for the insurance company over a long period of time, and they're one of the best products for you, because it shifted the risk off of you and put it on the insurance company in the form of a guaranteed death benefit and a guaranteed interest rate. So folks, I hope this video opened your eyes a little bit. I hope it opened your eyes without you having to put the reading glasses on to try to be like, what did he say? What? How much? You win. That's the name of the game. But it's actually a win-win, and that is the name of life. Thanks for joining us for this episode. And also, hey, by the way, if you liked this one, you're going to want to check this one out. How I lost $534,000 with the infinite banking concept. Check it out. See you next time.